Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our EIA show where we're going to go through our normal breakdown of looking at what's happening within the global backdrop, how are things changing, and then we're going to go deeper into some of the high-level EIA numbers. And then in segment 2, we're going to go deeper into refined products. How is demand now? Where is demand trending? And then in segment 3, we're going to go abroad, look at how are U.S. exports changing and where are we seeing some shifts, because again, diesel remains that bright spot when we're looking at what's happening in Asia and how are things really adjusting, because I think that's where we're going to want to look at what's happening with floating storage, what's happening with cargoes in motion, and where is some of these different pieces moving towards, because right now there's a big shift in terms of where is the crude going and what type of crude, because I think that's going to be the important backdrop when we're looking at pricing. So one of the things on a broad basis, the numbers were a bit bearish. Nothing crazy though. Like it was very let's call it normal when you're looking at, especially when you're looking at crude. It was very normal when you're looking at the top line number. Obviously, we had a big draw from pad 2 in Cushing, but then a really sizable build in pad 3, which really offset that draw in pad 2. Diesel, well, I should say distillate, still remains the bright spot, where gasoline is moving in a very seasonally normal pattern. So nothing to say one way or the other, but it's diesel that and distillate that remains the bright spot. One of the things, so we just wanted to pull this to the top when we're looking at what's happened last week and what do we expect coming this week. And this is, I think, a good chart that's showing what we've been highlighting when you look at total crude stocks, both land and floating storage. We continue to be above that average, and obviously below 2020, but above the 2017 to 2019 range. That has really been talked about, just to look at where are we versus kind of that normal 3 years versus where we were in 2020 and as we are in 2021. So we still continue to see a build. It started a little bit early, and then one of the things that we've been talking about is some of this new crude that has gone into floating storage will come onshore. So it'll be that pivot just from one side to the other as there is more floating crude that is in motion, which we'll talk about in segment 3. Total oil products remains the bright spot. One of the things that we've been talking about is that we expect it just to go sideways at this point, and that just is going to put us in a bit more of a normal standpoint as comps get easier. But again, nothing too crazy one way or the other. And then when you look, we flipped from a surplus into we flipped from a deficit into a surplus when you look at total oil and total products. So that's looking at total oil product stockpiles. That's looking at total oil, both onshore and offshore, merged together. We're above that average. Again, still trending fairly normal, nothing too crazy one way or the other. But then when we go a bit deeper, there are some important shifts. Now, Putin has come out and said that Gazprom will focus on filling EU storage come November 8th. We want to look at Germany and Austria when we look at where that storage is going to be. But that has put a little bit of pressure on what is happening on crude, just because it'll help offset. But again, it's now October 27th. Will it actually happen? Are there going to be strings attached to that? So this is why we still think that distillate is that spot to look at. But oil continues to move into Asia, but it's really not coming from the U.S. and Europe. And the reason why is just because of the spreads, which is why we've seen ESPO get bid fairly strong, as we've been saying, about $6 above dated Brent. And SOMO, coming out of Iraq, has now gone to a slight premium of about 15 cents against OSP versus a deficit of about 20 cents. And it's really because they're starting to get a bit more movement from the Middle East. And just when you think about where the spreads are coming out of the U.S. and Europe, then you have to factor in shipping time, shipping rates, how many additional days on a boat will you be coming from the U.S. versus other. So again, that's why you're seeing, even though there's some of that premium, it's still not enough to close the gap to incentivize additional movement from the U.S. or Europe. And then one of the things that we continue to see in China is you're getting more rationing of diesel, more ways to try to adjust where the flows are going. We've already had a big drop in exports, with a lot of the teapots saying that they will not be exporting so far through November. Just that's what we've seen so far. Again, that could change depending on how early winter comes, what the demand pull looks like. But that's going to be something to look at to see how are the other regions shifting, and that's where we get support for Japan, South Korea, India increasing their run rates, which are continuing to move up. And we'll talk about India in a minute. So I should say in segment 3. So then when we look at land storage, so just looking purely at land, you can see that we're fairly normal on the east of Suez side, where we're in a bit of a surplus. And then when you look at west of Suez, we still are below by about 21.6 million. And here's where we're starting to kind of climb that ladder a bit, but just based on where PADD 2 is and where Europe is, which is still below, so really west of Suez is going to be the one that is going to see the reduction versus east of Suez. The question will be, how does PADD 2 really start to fit back into that mold? Now, when we look at imports of clean products from East Asia, will rise this month to the highest since at least the start of 2020 when you're looking at Europe. And it's really because that ARB is still open, and it was open when it was moving in. So we continue to see gas oil coming from Asia into Europe, and then from Europe sending fuel oil from the Atlantic Basin into Asia. But we also have a decent amount coming from Europe into PADD 1, because when you look at distillate storage is very normal in the U.S. except for the East Coast. And that's, again, a huge portion of the bullishness, because that's where we use the most amount of heating oil. So again, even though some of the areas have excess, it's just a matter of how do you get it into those regions, which is going to keep that flow coming from Europe into PADD 1, or really the East Coast, as shipments continue. And cargoes that have arrived or that have already arrived in October amount to about 640,000 tons, which is the highest since April 2020, with more on its way, which will bring the total monthly arrivals into Europe at 720,000, which is the highest since at least January 2020. So again, you're starting to see, that's where Europe is going to take this in. And then we'll see some of that ARB, and it might make sense to see that re-exported into PADD 1 at this point. Then when we look at floating storage, here you can see floating storage is coming into those 2021. That it's at the highest it's been in Asia this month since 2021. But then when you look at floating storage in general and break it out, west of Suez, we're fairly normal versus where we've been. That's starting to creep back higher, really driven by West Africa. But then when you look at east of Suez, it's at the highs, and it's going to stay at those highs just based on where those flows are going and some of the issues that remain on the in the east of Suez. So again, we expect to see this floating storage remain well above that 3-year average. Obviously not really getting to 2020 levels. But when you look at that chart, 2020 was coming down to a more normal level by December. So when you have this year, things just going sideways, the comps, again, continue to get easier. Now, shifting to the U.S. for a moment, here you can see the fairly normal move in crude oil inventories. One of the things that we said last week was that we expected to see a build, and the pace was essentially going to match what we saw in 2019 as well as 2018. And so far, that's exactly where we are. And we don't see that pace changing. We see another kind of fairly continuous build. Nothing aggressive, like we're not going to see this huge hockey stick go up. It's just going to be a fairly steady build driven by lack of exports coming from PADD 3 or the Gulf of Mexico, and additional imports continuing to come through, as we've been talking about, just as those cargoes continue to show up on the within the U.S. And then when you look at China will ban the construction of refiners that have crude distillation units with smaller capacity than 10 million tons a year. So realistically, you're starting to see that shift where they're going to look for the major capacity, because they do want to have both refining and petchem together, and they want to have some of that opportunity. And then when you look at October loading shipments of clean fuels from Asia to the Americas increased to 425,000 tons as of Monday, which is up from 320,000 tons earlier this week. So again, there's going to be that additional shift, and a lot of that will show up in pad 5. So then when we look at days of crude oil, right now, as we were saying, we didn't expect it to go up or down all that much, just because we do expect to see an increase in oil storage. But refiners continue to be very underutilized versus this time of year. So there's going to be a bit of this kind of competition, because we'll have a little bit of a slower build or the pace in crude. But again, it's just days of crude supply. It's going to be fairly normal, nothing too crazy one way or the other. But one of the things that we want to look at is the Middle Eastern oil product arrivals in Europe, and how that's going to shift where those flows are going, because it's going to continue to come into the Atlantic Basin, and there is a chance where it can just get resold into the U.S. So then the question will be, how does distillate react, and is that going to offset some of the growth? Because we should have seen pad 1 reacting. Again, the Philadelphia refinery that exploded, that is now offline, permanently offline. So that is creating some of this shortfall, and how much of that can be made up coming from pad 3. So then when we look at where all overall U.S. commercial oil storage and products are looking, this is where, as we were saying, we expected to see that small increase, and it's going to be a mixture of what is driving it. Because right now, because we do have runs so low, we have oil that is building and we have products that are drawing. And now at some point over the next really 3 weeks, depending on when we get that real shift into products, then we'll start to see oil draw down again and products building. So we do expect to see a fairly stable move, very much along the lines of that 2018-2019 level. Again, just this fairly steady move, nothing shocking one way or the other. And when you look at the seasonality, we saw the same thing in 2015. We saw something similar when you look at what happened in 2016. There's nothing too crazy in terms of what we're saying right now or going out on a limb, just very much seasonal norms. So then when you look at those October loadings, that 425,000 tons as of Monday is going to be that more important side to see what does that do to the distillate side, because our refiners going to start to ramp up just as some of this product hits our shores. And even with that being said, when you look at what are some of the movements right now, transatlantic gasoline arrivals continue to fall, just below 100,000 barrels a day now. That's something that we've been saying is going to continue just because gasoline demand is slowing. Again, along seasonal lines, nothing too crazy, especially when you look at where we normally see that decline coming down. You can see that we had it in 2019. We had it pretty much every year going back the last 29 years, where you get that dip into the beginning of November. And then you get that acceleration. And the reason why you get that acceleration is because weather is a hindrance to just where some of this demand is going to be. But you'll get the gasoline gets thrown off when you make that diesel cut. So as you make diesel and heating oil, you'll naturally get that gasoline and you don't have the demand. Just, again, seasonally speaking, you don't have the demand. So that's where you start to see that build up going into January. And we just expect gasoline shipments coming from Europe into the U.S. to be fairly nominal, if not very low. And we do see more activity coming out of Latin America, which will absorb some of that additional capacity that's in Pad 3, while Pad 1 continues to take in imports. Then when you look at distillate again remains at that low point. This is where we've been here before, but based on where prices are, you would expect to see this start to swing. This remains the key point, which is, again, why we talk so much about where are imports and exports. Then when we look at jet is very stable, and kerosene is going to be in competition with the disti pool. Based on what we're seeing so far on the airline side, there's nothing too crazy as demand remains right where we thought it was going to be at this point in time. Then when you look at the WTI crude curve, you can see it's come down a bit. Just on the front end, just because crude came down about $2, but still things remain fairly bullish when you look at where things sit across the curve, as we've looked at it based on where we were in against the 75 price mark, 70 and 65. And then when you look at what's happening in China, we did get another crude quota for about 12 million tons for Beijing Petroleum and Chemical. And it's because there's an additional capacity coming online. So it's just going to come in to fill that void. And we do have new capacity coming on through really the next 3 to 4 years, which we've talked about. But that's where, when we keep discussing how crude products are going to change really over the coming few years, with China looking to export more. Then looking at COVID, things have ramped up a bit in the UK, but still very manageable on a world level, fairly stable. US continues to come down. South Korea had a little bit of an increase, nothing to be concerned about. Asia Pacific as well. Singapore is continuing to climb higher. Russia as well. Vietnam stopped going down, kind of find that plateau and starting to increase a little bit. But when you look at Latin America, when you look at Asia, we don't see any broad cuts. We don't see anything really changing. We do have vaccinations that have ramped up and things staying fairly normal, which we don't think adjusting at any point in time. Then when you look at crude stocks, we had a build of 4,270,000. And so when you look at where we sit right now, East Coast had a small build of 110,000. Pad 2 had a draw of just over 3 million. Cushing had a draw of 3.9 million. That's now 24.7 million below the 5-year average. We'll talk about that more in a minute. Pad 3 had a big build of 8.62 million, putting us over 14 million above the 5-year average. Pad 4, small draw, but still in line with the 5-year. Pad 5 had a draw of 1.01 million, fairly in line with where we are versus the 5-year, just 3 million below. And then when you look at factoring in the SPR, you can see that we initially had a build of 4.27 million, but when you look at the amount that was pulled out from the SPR, we only had a build of about 3.18. So that's where you're still getting some of those shifts. Some of that is showing up in Pad 3 just based on the swaps, and that's putting that additional pressure within the region. The one to watch is Pad 2, and one of the things that we said back in 2018 and really continued on with was how important is Cushing, just given there has been a lot of debottlenecking coming out of the Permian. A lot of that is bypass Cushing and come straight into Pad 3. It's still an important point, just because when you think about where the contracts settle, where the physicals delivered, that's where we're going to want to look to see, do we get any reversal coming from Pad 3 and moving up into Cushing? Or do we get some of that swap and they'll just say that, oh, the crude is already in Pad 3, not in Cushing, but we'll settle that on a physical side. These are going to be some of the nuances that we're going to want to look at, because realistically, Cushing could fill quickly based on where we are coming from Canada and the amount of crude sitting in Pad 3. The question will be, does it make sense? Or are we going to see a new paradigm kind of opening up at this point? It'll be interesting to see how it develops, just given where we were at tank tops, now near tank lows, and how that narrative continues to kind of shift around. Now, when we look at a broad overview of where congestion is, so you can see congestion has started to normalize a bit in Europe after that nice spike. Again, very much along seasonal lines. You get a big movement, then you start to see it come back, fairly normal. China had a big spike following a slowdown in activity. That is now coming down a bit, just because they do have that new COVID outbreak. So the new COVID outbreak is just starting to slow things down, just because it's now in 13 provinces. Still just about at normal, if you will, or about 100. And then when you look at some of the other changes, North America or the Americas has gotten better on the back of Latin America, has continued to improve. And then the rest of Asia, as we talked about earlier, with that normalization on COVID cases, things have gotten back to normal. When we look at Google specifically, you can see that we're still off just a bit. When you look at the world, we're getting there. We're about let's call it 92% of normal. And that's something that we expect to see start to close that gap as we progress through the end of the year, and where Apple Mobility is showing something a bit more aggressive. Again, it's just a matter of how is it calculated overall. And one of the things that we're going to be looking at is how is China going to be impacted based on COVID, based on the economic slowdown that continues there. and how much is that going to impact, because we continue to see a slowdown in imports coming into the region, where, right now, even though the teapot's got a new quota, we still haven't seen all that much really increase in the area. And then when we look at pad 3, as we were talking, it's now at the second highest it's ever been. When you look at this, again, seasonally speaking, it's above where we were in 2016. Obviously, we're below where we were in 2020, but you can see that the pace continues to accelerate. And when we look at the lack of exports and the steady move in imports, we expect the pace to maintain where we were in 2016. So we do think that we'll continue to see those builds in pad 3. Now, when we look at Cushing, here you can see that steep drop, the lowest it's been for 2021. And when we want to talk about it, we wanted to focus in a bit more over the last couple of years. So here's where we look, just going back over the last 10, you can see we're below where we were in 2018, where 2018 you started to see a fairly healthy move higher. We're above where we were in 2014. Now, one of the things that we were expecting was that as we got to this 2018 level and as we got to where we were in 2013, we thought we were going to get this pivot higher and it was going to match that pace of builds. Again, not really getting back to the average, but at least starting to close the gap for that roll. Instead, we had another shift down. So this is going to be an important one to watch to see how is the contract going to be managed as we head into the December expiry. Where is that going to settle? Are we seeing something shifting where Cushing is going to be bypassed and the new normal is going to be Houston and Louisiana when we're looking at pad 3? Or is this going to be that normal spot? And again, these are going to be things that are going to be important, especially when we look at some of those financial moves and physical transfers in terms of Cushing versus pad 3. Then when we look at just where runs are right now, runs only had a small increase of 40 basis points, went from 84.7% to 85.1%. Fairly average for the five-year average, a bit low when you span it out over the last 29 years. We do expect this to continue to climb higher and hit about 87% by the time we get into really the first week of November. And then it'll stay there and then slowly climb to about 89% and probably peak out at about 92% as we get to kind of that peak level of demand coming into winter. But we could get an overshoot, so that's going to be something to watch. And as we get closer and to see how these guys are starting to manage their splits, we'll get an idea of how much additional capacity to expect. Pad 3 had that recovery after some unplanned downtime, so we had that increase of 103,000 barrels a day throughput. Pad 1, it continues to be well below the 5-year average, as well as Pad 3, with Pad 2 really, again, taking down, running 239,000 barrels above normal, which, again, can account for those draws in Pad 2, those draws in Cushing. So that's why I think that Canadian crude is going to be so important when you look at how those shifts are, where Line 3 is, and how much of that continues to price itself into the market. And then when you look at imports, imports were up 430,000 barrels a day. Pad 3 still remains light, only an increase of 65,000 barrels a day. That's where we continue to see those that accelerate. Pad 2, small dip of 150,000 barrels. That we thought we were going to get a little bit of a bump. Instead, we got a little bit of a drop. That's something that we think will reverse, with Pad 5 having a big reversal from last week, increasing 549,000 barrels a day, going well above the 5-year average. But you can see we're still well below that normal input backdrop, which is going to be something to watch as we go forward, because it's really Pad 3 that I think closes the gap. And it's just going to be that timing as to when those crudes show up from West Africa, from the Middle East, which are en route, starting to get here, starting to unload, which is why we got that small increase. I just expect that to continue to accelerate over the coming weeks. Implied demand had a bit of a dip. When you look at gasoline was down 311,000 barrels a day. We should get a move back up based on where some of the data was. We thought we were going to get a little bit of a move lower, just below 9.3. Instead, we were about 9.323. So kind of right in line with where we were thinking. There we expect to get a little bit of a bump, and then seasonally speaking, a move closer to 9.1. Diesel had a big drop of 409,000 barrels. We were expecting a little bit less of a drop, something closer where we went from 4.278 to about 3.869 million barrels a day of demand. We thought we were going to hang a little bit closer to that 4. So it just means that we're going to get a bigger makeup when we look back next week. Jet, right in line with what our expectations are about that 1.4 million barrels a day of demand, with propane having a small drop of 108,000 barrels. That's something that we think, again, will bounce back up. But those shifts in that distillate, because right now, when you look at what's happened on the, and we'll talk more about this in the Econ show, we've had the biggest disconnect on the trade balance ever. So exports had a big drop, imports had a big increase. Imports are going to continue to be strong, which again is going to keep that distillate well bid when you look at the movements from the perspective of trucking, and then as we go further into heating demand season. So then when we look at what's happened in floating storage in the U.S., still zero. That's something that we think is going to reverse over the coming weeks. Imports into PADD 3 just kind of flatlining. We still think that this is going to continue to climb higher. Again, not getting to the 5-year average, but getting just closer to those high points that we had over the last few months. And then when you look at PADD 2, we were expecting this to come up a little bit. Instead, it came back to the 5-year average. So it's just we just expect to see that bounce over the next week. Here's where we look at refinery utilization rates. You can see that we normally get a steady grind into the end of November. I should say grind higher. Here you can see we're starting from a much lower point. We just think the pace is going to accelerate as we get into mid and November. And the reason why we got this drop, you can see that we went above the 29-year average and then that dip below. And that was because we had a shift in downtime. Instead of it happening in October, earlier October, later September, because of the hurricanes, a lot of that was shifted because they wanted to run a bit harder, and now that's why we're still below. But as we come out of it, we'll catch up and get close to, and I think we'll most likely match that 29-year average through the end of the year. So now that we've gone through where refiners are, where things are shifting, we want to look a bit deeper now into what is happening in refined product demand, production, and how is that going to shake out over the next few weeks in the U.S.